Okay, so let's start. We want to start from or continue from where we left. We want to continue from where we left last time. We were discussing the topic of internal reconstruction, and we were discussing how to design a scheme of internal reconstruction. We were talking about how to design a scheme of internal reconstruction. That's what we were discussing last time. Okay, so that's what we want to continue from today. We want to do a question from the past papers. For first, let me ask, are you able to hear me? So you chat and tell me, are you able to hear me? Chat and say yes. Chat and tell me whether you're able to hear me. Chat and you say yes, that you're able to hear me so that I can continue. Chat and you say yes. Are you able to hear me now? Are you able to hear me so that we continue? You chat and you say yes. Chat and you say that you're able to hear me now. Are you able to hear me? You chat and say yes. Chat and you tell me that you're able to hear me now. Oh, good. Thank you. So let's continue now from where we left. Let's now continue. Okay, fine. So we were discussing, thank you. We were discussing how last time that whenever you are given a question of internal reconstruction, there are two ways in which the examiner can test you on that topic of internal reconstruction. One way is where we said you are given a scheme, you only implement that scheme of internal reconstruction. That's one way of being tested on that kind of a topic, internal reconstruction. We did a question of November 2016 where the examiner had given you a scheme, then he wanted you to implement that scheme. Then we said another way in which the question may be tested is where the examiner does not give you a scheme of internal reconstruction, but he requires that you first design your own scheme. From the information he will give you, you design your own scheme of internal reconstruction. Then from there, now you implement the scheme. So we looked at how to design a scheme. And we went through the 4 steps that are normally followed. We went through the 4 steps that are normally followed in trying to design a scheme of internal reconstruction. So you can see, we said step number 1 is to determine the total loss to be written off. Whenever you are required to design a scheme of internal reconstruction, first thing you must do as a person reconstructing a company is to determine the total loss to be written off. We said from the question or from that company that you are trying to reconstruct, find out, are there any losses that this company will suffer in the process of trying to reconstruct themselves? If they are there, we said you identify the losses. Then we said it may also happen that in the process of trying to reconstruct the company, there could be some gains that the company will make. And if there are any gains that the company will make, use those gains to reduce the losses. Then we identified and said, what are some of the losses that the company may suffer whenever they are reconstructing themselves? 1, we said, if before reconstruction, you can see from the left side here, we said if before reconstruction, one of your assets had a book value of 5 million, but after reconstruction, it will go into the books at 4 million, then automatically your company will suffer loss. If the assets of the company were 5 million before we reconstructed, but after reconstruction, the assets of the company will go to the books, or the asset will go to the books at 4 million, then as a company we are losing. So we said any decrease in value of an asset, any decrease in value of an asset will automatically give rise to a loss. Then we said, what if you have another asset which before we reconstructed the company, it had a book value of 5 million, but after reconstruction, it will go into the company's books at 6 million. Maybe that's the fair value of the asset. Meaning that after reconstruction, our company will gain. That means if there is any increase in value of an asset, we said that will give rise to a gain. That will give rise to a gain. I think we had written the notes in summary from properly are here. They are here. That's what we said. So number one, with any decrease in value of an asset, we said that will give rise to losses. With any increase in value of a liability, assets, with any increase, that will give us a gain. Then we also talked about what if you have liabilities also. As a company, you have liabilities which appeared in your books maybe at 5 million. But after reconstructing the company, our liabilities will now go back to the books at 6 million. You had some liabilities, whichever they are, which appeared in the books at 5 million. But after reconstruction, the liability will now appear in your books at 6 million. We said that automatically means that as a company, we are losing. As a company, we are losing. Why? Because our liabilities are increasing. And so we said that will give rise to a loss. Whenever there is increase in liabilities, that will give rise to a loss. Then we said, what if you have another liability which currently, before we reconstruct our company, has a value of 5 million, but after reconstruction, maybe it will go into the books of the company at 4 million. We said that automatically will give rise to a gain because we had more liabilities before we reconstructed. Now our liabilities are reducing. As a company, we are gaining. So down there, we said if there's any decrease in value of a liability, that will give rise to a gain. I'm only reminding you very fast. Good. Then we said, what are the other components that can give rise to losses? We said another thing that could happen that makes your company to suffer in the process of reconstruction is any reconstruction cost. Maybe in the process of reconstructing your company, the question tells you you will spend 2 million shillings to reconstruct the company. Of course, that will make your company to suffer a loss. They also said accumulated losses, which I told you, and I hope you have not forgotten. We said in a reconstruction of a company, any accumulated losses of the company must be written off. Whether the examiner reminds you or does not remind you, I hope you still remember that. We said they must be written off. Good. The other one is what we called any contingent liabilities. If there is a contingent liability, your company had a contingent liability before we reconstructed. Listen. Before we start reconstructing, we said your company had a contingent liability. And I told you, contingent liabilities don't appear in the books. Normally, they don't appear in the balance sheet. But then we said, the moment you start reconstructing a company, that contingent liability, we said, should be crystallized. Yani, make it a liability. Make it a liability. By making it a liability in the books, we concluded this. It means that before reconstruction, in our books, we did not have that liability, but after reconstruction, now we shall have it in the books. So it means like your liabilities are increasing, and therefore, that will give rise to losses. And I do hope you remember, we said one example of a contingent liability is what we were giving as preference dividends in arrears, as preference dividends in arrears. That was one example. So those are some of the components of losses. From the gains, we have already identified two: any increase in assets, any decrease in liabilities. Then I also told you, if there are any reserves your company have, whether general reserve, share premium, revaluation reserve, any reserve that your company has, whenever you are reconstructing a company, that reserve normally should be written off. That reserve should be written off. Now, by writing off a reserve, we said, remember, reserves are amounts that belong to shareholders, whether share premium, whether general reserve, whether revaluation reserve. These are amounts that belong to shareholders. And if they are to be written off, then as a company, not as shareholders, as a company, we are gaining. How? Because we are writing them off, meaning we are reducing what we owe. We are reducing what we owe to the shareholders. So we said any reserves to be written off will automatically give rise to a gain. Will automatically give rise to a gain. So once you have identified the losses, once you have identified the gains, get the net of the losses and the gains, and then get the net amount. And that net amount is what we were calling the loss to be written off, the loss to be written off. Good. So maybe before we go to step 2, for the sake of the new students, there are some new students who have joined because today is the free class. Listen, for the sake of the new students, I'm explaining something here. Sometimes you may be disconnected. Sometimes you may be disconnected because of your Wi-Fi strength being weak. I'm talking to the new students now. If you are disconnected because of your Wi-Fi strength being weak, especially when you are watching a live class, listen, there are 2 ways in which you can use to come back to class. Now, first, before I talk about the 2 ways, if you try and click, listen, if you try and click on the disconnected video and it doesn't bring you back to class, then one way to come back to class is to click the refresh button. That means you refresh the page from which you are watching the video from. Normally, on the top left or on the top right of your page, whichever gadget you are watching from, that gadget could have a refresh button, meaning you refresh the page. Of course, some refresh buttons appear like this, something of that nature. That's how they appear. If your gadget doesn't have that button to refresh the page, then the other second way you can use to come back to class is to go back to the group where the link was posted and you click on the link so that you join the class again. It's like you're joining the class again. So for those students who are new and they don't know that kind of modality, we have said, sometimes when you're watching a live class, you may be disconnected because of your Wi-Fi strength being weak. If you are disconnected, then we are saying either you refresh the page or you go back to the group, click on the link. That will only happen if you try to click on the disconnected video and it doesn't bring you back to class. Good. Also now, listen, for any one of you, all of you now, for all of you who have not subscribed to my YouTube channel, I would ask you to subscribe to my YouTube channel. You can even click that button of subscribe as you are watching now. You can click it. Then you also click the notification bell so that you are notified whenever we post videos in our YouTube channel. So I would ask you, if you have not subscribed to my YouTube channel, please subscribe by just clicking the button down there on subscription. Then you click on the notification bell. You subscribe and you click on the notification bell so that you can be notified anytime we post new videos in the YouTube. Good. Now, so let's go back to our discussion. We have done step number 1. I do hope you remember what we said is step 2. Remember, listen, I'm just reminding you first. We said, whenever you are reconstructing a company through internal reconstruction, we said, all the stakeholders of the company are called into a meeting. The stakeholders include ordinary shareholders, creditors, preference shareholders, debenture holders. That's why we are calling it internal reconstruction. Whatever loss you have got, I do remember in our previous illustration, we were assuming something like 5 million. Assuming you got a total loss of 5 million to be written off. So we were asking ourselves, who among the stakeholders of the company should be requested? Who among the stakeholders of the company should be requested to suffer this loss that we have got is step 1. Should we request the ordinary shareholders to take it over? Should we request the preference shareholders? Should we request the debenture holders? Who among the stakeholders of the company should be requested to suffer that loss? We said, listen, we are reconstructing this company. But then, for us to know who among the stakeholders are to be requested, we need to ask ourselves, listen, who is this stakeholder? Who is this stakeholder who, even if he goes to the court and asks for the company to be liquidated, who is this stakeholder who, even if he goes to court and asks for the company to be liquidated, he will still lose? Because we said, whenever a company is liquidated, normally assets of the company are sold and then liabilities are paid in order of priority. You have done the topic of winding up of companies. You know the order of priorities. That's what we discussed also last time. Now listen. So it may happen, or you may realize, that in case the company is liquidated, the assets will be sold for this much. Then liabilities will be paid in the following order. Then a time will come when the money is already finished, but there are some stakeholders down there as per the list of priority who will not get anything. Those are the ones you now go back to and tell them, instead of going to court and asking for the company to be liquidated, and you still lose or you don't get anything, why can't you accept to suffer this loss of 5 million on reconstruction of the company with the hope that the company will make a profit in the future, and you as a stakeholder, you will be able to participate in that profit? So that is the stakeholder we want to identify. And that's what we said. We now go to step 2. So step 2 now, we said you prepare. Listen, we said you prepare a distribution statement. You prepare a distribution statement of the sales proceeds, from the sale of assets, on the assumption, listen, on the assumption that the company is liquidated. We are not liquidating, but on the assumption that the company is liquidated, you prepare a distribution statement of the sales proceeds from the sale of assets. Then you come and say, machinery will be sold for this much, furniture this much, bank this much, data this much, and so on. What shall we realize? So when I was doing step 2, we just assumed the total sale of assets, whatever it is. Then we said, which liabilities are normally paid first in order of priority? We said, whenever a company is liquidated, secured liabilities are normally paid first. So you pay the secured liability, and of course I told you secured liabilities are attached to a specific asset. That's why we are deducting them straight from the asset itself. Whatever you get now, we will get none. Then I told you add the cash, because cash we don't sell. It's already there. Cash we don't sell. Once you pay the secured creditors and money is still remaining, we went on and looked at the priority of the other liabilities. After paying the secured creditors, we said the next liability to be paid will be liquidation expenses. Once you pay the liquidation expense and money is still remaining, we said you pay the preferential creditors. After you pay the preferential creditors, money is still remaining, we said you now pay the debentures on a floating charge. After you pay the debentures on a floating charge, we said you pay the unsecured creditors. And I told you, listen, as far as unsecured creditors is concerned, I told you it is not that we are saying only the trade creditors, they are unsecured. No, I told you when it comes to liquidation of companies, any liability that does not have security, that liability is normally classified as unsecured creditors. I told you it could be bank overdraft, that has no security. It could be normal bank loan, which did not have security, or it could be the normal trade creditors. So any liability that does not have security, we normally classify it as unsecured creditors. So you combine all of the liabilities which don't have any securities, and then you pay them at that stage. After you pay the unsecured creditors and money was still remaining, then we talked about you now have to pay the shareholders. With the shareholders, I told you, your company could have ordinary shareholders or preference shareholders. You remember, I said for preference shareholders, there could be two things you owe to the preference shareholders. One, you could be owing them their dividends that are still in arrears. And two, you owe them their share capital. So we said normally, in order of priority, what should be paid first to them? Said the first thing that they should be paid first is the arrears. So assuming you paid the arrears and money was still remaining. After that, we said, you now pay them their preference share capital, whatever it is. Once you pay the preference share capital their money, anything remaining, I told you, any other money remaining now will go to who? To the ordinary shareholders. Will go to the ordinary shareholders to pay their share capital. So from that list, it will guide you, because somewhere, listen, this is just to illustrate how the order goes. But we have not said that it will reach the end there. No, I'm only showing you up to the end, where money remaining after paying the preference share capital, anything remaining normally goes to the ordinary shareholders. Good. But then we said it could stop at a particular point on the upper line there, whichever the point from your question, it will stop. It is from there that you should be able to conclude. Once you stop at a point, whoever will not get as per the list now, that is the person you go back to. It could be ordinary, it could be preference, it could be debenture holders. You go back to them and tell them, now that we have realized from this statement, you can even see from yourself, you as ordinary shareholders, or you can see yourself, you as preference shareholders, that in case this company is liquidated, this is how the assets will be sold, this is how the liabilities will be paid, and it is obvious you will not be reached. By the time the money is getting finished, you will not be reached. So you tell them, now with that now, please accept to suffer the loss of 5 million that we got in step 1, with the hope that we shall make some profit in the future as a company, and you will be able to participate in that profit. So that is how you conclude from step 2. Otherwise, we are not liquidating this company. We are reconstructing the company. But step 2 was only there to help you to conclude who should suffer the loss. Good. Once you determine who's to suffer the loss, we go to step 3 now. Step 3, I told you, you now determine the loss reduction per share. You determine the loss reduction per share. How? We get the total loss, whatever you have got in step 1, you divide that by number of shares. I told you it could be ordinary shares or it could be preference shares, whoever it is that is required to suffer that loss. Good. That was our step number 3. Then I told you step number 4 now, you suggest a scheme of internal reconstruction. You suggest a scheme of internal reconstruction. Listen, I told you, what should you include in that scheme? I told you, one of the things that you must include in the scheme is anything that you got in step 3. Anything that you got in step 3 must be part of the scheme. And what is it that you got? Whatever was the loss reduction per share. It could be you are required to write off 5 shillings per share on ordinary, or maybe on preference, whatever it is that you concluded or you got in step 3. That must be part of the scheme. That's 1. Then I told you, what else should you include in the scheme as note 2, as item 3, item 4, item 5 in the scheme. That I told you, that for any other item in the scheme, you go back to step number 1. Anything that we used in the determination in step 1, anything that we used in the determination of that loss, which we are assuming to be 5 million, anything that we used in the determination of that loss of 5 million must be part of the scheme. What are those items? Listen, you revalue some assets. Once the assets are revalued, some will give us losses, some will give us gains, hapo chini. So you may say assets to be revalued to their fair values as follows. The question will give you the fair values of the assets. Then you may say liabilities to be revalued to their fair values, blah, blah, blah. Some of them will give you losses, some of them will give you gains. The question somewhere in the notes might tell you there is a reconstruction cost of this much. You come and now say, in the scheme, reconstruction cost to be incurred, maybe 2 million, 1 million, and so on. The other item we used in step 1 was accumulated losses. So you can put in the scheme and say accumulated losses to be written off, whatever it is. Another thing we used in step 1 was this contingent liability, which we gave as example, preference dividends in arrears. So you could say as part of the scheme, preference dividends in arrears to be paid in cash, whatever it is. Those are the losses. Among the gains, I can see we have not used the reserves. So among the items in the scheme, you could say reserves to be written off. Maybe it's share premium, maybe it's general reserve. That's what you could put in the scheme. Good. So I think I've reminded you on how to design a scheme of internal reconstruction. Now, how to design those 4 steps. Step number 1, determine the total loss to be written off. Step number 2, prepare a distribution statement of the sales proceeds from the sale of assets on the assumption that the company is to be liquidated. I've told you this is done. That's step 2. That is done so as to determine who among the stakeholders of the company is to be requested to suffer the loss in step number 1. Who among them is to be requested? Otherwise, we are not liquidating, we are reconstructing. Once you know who, then you go to step 3. Now you determine the loss reduction per share by taking the total loss that stakeholder will lose, divide by the number of shares. Then you now go to step 4, where we have said you suggest a scheme of internal reconstruction. I've told you what should be included in the scheme. One thing that must be included is anything that we got in step 3. That must be part of the scheme. Then what else should be part of the scheme? I've told you anything that you used in step 1 to determine the total loss of 5 million, that which you used must be part of the scheme. With that idea now, I want to project a question now, which is an old past paper question, but a good one for practice because it's quite a bit involving. It has more than other questions that have come in the past, in the recent times. So I want to project it so that we do it together. Okay, sawa. So let me project the question that I want us to do. That was a question of June 2008. That's a question of June 2008. I want us to read it. It says, Matatizo Limited has been operating profitably until 3 years ago, when it started experiencing financial problems. This resulted in the business incurring heavy trading losses. The directors of the company, who are also the main shareholders, considered undertaking either an internal or external reconstruction. Based on professional advice, the directors opted for internal reconstruction. It was anticipated that after reconstruction, the company would make an annual profit before interest and tax of shillings 300 million. Then you are told the tax rate was expected to be 30%. Let me roll the question now. After that, you are given the balance sheet of the company as at 31st of March 2008 before reconstruction was as follows. You are given the assets, among them non-current assets, land and buildings, furniture, motor vehicle, goodwill. Among the current assets, you have inventory, trade receivables. Let me roll again the question. After current assets, we now go to capital. That is equity and liabilities. Now we have ordinary share capital of 10 par value. We have 9% cumulative preference share capital of 10 par value. You have revaluation reserve. You have profit and loss. If you look at the profit and loss, it's in bracket, meaning our company has an accumulated loss. Okay. Then we go to non-current liabilities. Among them, we have the 10% debentures, which is in bracket, they are saying in bracket, secured on land and buildings. Secured on land and buildings. Next, we have current liabilities. Among them, we have bank overdraft. And they are telling us again in bracket, secured on a floating charge. Secured on a floating charge on assets. Then finally, we have trade payables. After that, I think now we go to the additional because that's the balance sheet. Yes, let's go to the additional information now. Additional information. Number one, the cost of the scheme of reconstruction were estimated to be 4.5 million. That's the reconstruction cost. Number two, preference dividends were 2 years in arrears. Number three, the fair value of the assets as the 31st of March 2008 were as follows. Land and buildings, 777. Furniture and equipment, 435. Motor vehicles, 45. Inventories, 210. Trade receivables, 939. Number four, goodwill was considered to be valueless. Goodwill was considered to be valueless. Number five, trade payables include shillings 125 million that would be preferential in a liquidation. So they are just telling you among the creditors, there is 125 million that will be classified as a preferential creditor. That will be classified as a preferential creditor. Number six, preference shares rank in priority. Preference shares rank in priority to ordinary shares in the event of a winding up. Number seven, assume that internal reconstruction would be complete at the close of the business on 31st March 2008. Required. Number one, or A. Number A, they are saying, suggest a suitable scheme of capital reduction. Number two, prepare a capital reduction account. Number C, an opening balance sheet as at 1st of April 2008 after conclusion of the scheme of capital reduction. Number D, statement showing how the anticipated profit under the new arrangement would be distributed to the various providers of capital. So number A, they want us to prepare or to suggest a scheme of internal reconstruction. They want us to suggest a scheme of internal reconstruction. We have just reminded ourselves, so we need to go back now and do that now. We need to go back and do that now. So let's do that question of June 2008 now. Let's do that question of June 2008. So put it down, June 2008. It was question number 3. We want to go through the 4 steps to design a scheme of internal reconstruction. So let's put down step number 1. We have already agreed. Step 1, determine the total loss. Determine the total loss to be written off. 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 Now, I want to take you through first. Listen. Before we put down the figures, let's agree on what will go there generally. Of course, I've already told you we need to identify some of the losses. Listen, so I want us to go through and look at, for example, assets. I told you some assets will have to be revalued. Assets will have to be revalued after we have reconstructed. Some of them will give us a gain. Some of them will obviously give us a loss. So let's just, for the sake of it first, identify which assets will give loss and which ones will give a gain. So let me project the question. If you look at note number 3, for example, if you look at note number 3, we have somebody is asking a question. Let me see what somebody is asking. Somebody is asking a question. Just give me a minute. We ask ourselves, can you kindly send the question to the group? Yes, I'll send it, sorry. I'll send it to the group. Somebody else, please share the question. I forgot to share it in the group of those who have paid. I forgot to share it. I will do it. Sorry. Sawa. So let's go on. Let's go on now. I hope you are able to see, so that for now, you just use the question as it appears on the screen. Then I'll send it to the group. So what I was saying is this. If you look at the assets under number 3, the fair value of the assets as at 31st of March were as follows. One of them is land. It was revalued to 777. What was the original book value? That's what I want to check. From the original balance sheet, what was the original book value? If you look at the original book value of the land, it was 720 from the balance sheet up there. Now, after reconstruction, it will go into the books at 777. It is obvious that land will give us a gain. What about the next asset, furniture? According to the balance sheet, it has a book value of 480. 480, I hope you are seeing it there. What about after reconstruction? How much will it go back into the books at? Of course, from the balance sheet, from the note, it will go back to the books at 435. Are you seeing it down there? It will go back into the books at 435. That is obviously a loss. 480 was the original. Now it will go back into the books at 435. That will give rise to a loss. Another one I can see here is motor vehicle. Fair value 45. What about the original book value? Let's check. 45 is the fair value for the motor vehicle. And next one is for the furniture, for the motor vehicle. Originally it had a book value of 90. Now we are being given a fair value of 45. That's obvious. It's a loss. That's obvious is a loss. Next, I can see from the balance sheet is goodwill. Already, the additional information told us, somewhere you remember, we were told by a note that goodwill was considered to be valueless. So it is obvious it will give a loss, it will give rise to a loss. Next one, I can see among the current assets, now we have inventory. I can see book value 240. What is the fair value after reconstruction? We have fair value of how much under note number 3? Fair value 210. So 240 is the original book value. 210 is the fair value. That will give rise to a loss. Good. Next one is trade receivables. I can see fair value 939. What about the original? What about the original value of the trade receivables? I hope you can see there. It is 1020. Another loss. Good. So those are the only assets. Those are the only assets. So we have identified, listen, we have identified that among the items that will give rise to losses, several assets will be revalued downwards. One of them will be revalued upwards, and it will give rise to a gain. The other component of loss, we said, is any decrease in value, no, increase in value of a liability. Listen, any increase in value of a liability. Listen, from this question, there is nowhere we have read from the additional information that the liabilities will increase. No. We were only told something concerning trade payables. And that was not to tell us part of the creditors are considered preferential. Otherwise, there is no other information concerning liability. The only information we are given there is number 5, which says trade payables include 125 that will be preferential in a liquidation. Meaning, it's not that we are reducing it. No, they are trying to separate the creditors. But there is nowhere we have read any liability increasing or reducing. So from this question, there will be no gain, no loss in terms of liabilities. Then I told you, listen, what are the other components that can give rise to losses other than assets, other than liabilities? I told you the other one could be reconstruction cost, which according to our question, under note number 1, I remember there was a reconstruction cost, which was estimated to be 4.5. So that we shall bring it in. Next, after that, I told you another component of loss is the accumulated loss. I told you whenever you are reconstructing the company, accumulated losses must be written off. So this company has a loss. You remember I showed you the in balance sheet, in bracket, that was an accumulated loss. So it must be written off. So that we shall bring also. Next, I told you among the other losses that the company could suffer is if there is any contingent liability. If there is any contingent liability. I told you if there is any contingent liability, it will have to be crystallized. And by crystallizing, our liabilities will increase. Therefore, it will give us a loss. And we saw, listen, even if I remember, note number 2 told us preference dividends, I think, were 2 years in arrears. And you know, one example of a contingent liability is preference dividends in arrears. I told you, we have not paid them for the last 2 years. So even if you go to the balance sheet of this company, you will not see anywhere any preference dividends in arrears. You will never see them. Yet there are liabilities. And so we said they will have to be crystallized. So before we reconstruct, there was no liability. Now we shall have to create a liability. That means our liabilities will increase. That's a loss to the company. So those are the areas of losses. What about gains? We have identified a few items that can give rise to gains. 1, I told you any increase in value of an asset, which we have seen, land will give us a gain. 2, I told you any decrease in value of a liability will give us a gain. From this question, I've told you there was no change in liability anywhere as per the question. 3, I told you the other thing that can give rise to gains is any reserves which are there, whether share premium, general reserve, revaluation reserve, any reserves that the company has, normally it should be written off. So let me confirm from the question or from the balance sheet whether our company has any reserves, so that if there are any reserves, then we know they must be written off. They must be written off. So from this balance sheet, yeah, good. I can see among the capitals, we have a revaluation reserve of 450. That will be one of the reserves to be written off. There is no other reserve like share premium? No. Good. So I've taken you through the items that we are now going to use for step number 1. We now know them. So let's put them down now. Let's put them down. We have agreed one of them. Land was giving us a gain. Then after land, what was the next one? I've forgotten. After land, let me pick the next one from note number 3. That's where we are being revaluing. From note 3, the next one was furniture, 435. But what was the original book value for the furniture? It was 480. Good. It was 480. So we are saying our first asset that will give us a loss is furniture. Let's put in bracket 480 was the book value, but it has a fair value of 435. So when we shall take it back to the books at 435, we shall be losing as a company. So what is the loss? We take 480, we minus 435, so there will be a loss of 45. Our figures are in thousands in the balance sheet. So we put it as 45,000. Good. Next one, after that, we have identified the liabilities, the assets, of course. Next one, after furniture, I can see it's motor vehicle. I can see book value from the balance sheet. Book value is 90. What is the fair value? We go back to note number 3. Fair value is how much for the furniture? No, for the motor vehicle. The fair value is 45. That is a loss. So let's come and put it motor vehicle. From the balance sheet, book value is 90. We have seen from note number 3, the fair value is 45. So it will have a loss of another 45. Good. What is this other asset? We go back to the balance sheet. We are going back one and one and picking them one by one. After furniture, after motor vehicle, I can see from the balance sheet, the next one is goodwill. What's 60? We were even told by the note that goodwill was considered to be valueless. So it's already a loss of 60. So just come and put it, goodwill, 60. Next, after goodwill, we go back to the balance sheet. What's the next asset? After balance sheet, the next one is inventory. I think it was a loss. Book value, I can see 240. Book value 240 for inventory. What about fair value? Fair value for the inventory, I can see it here, 210, a loss of 30. So just come and see your inventory, 240 minus 210. That gives us a loss of 30. Next, after that, we go to the next asset after inventory. And the next one in the balance sheet is, after inventory, we go to trade receivables. And I can see trade receivables are given as 1020 in the balance sheet, 1020, while as per the additional, it has a fair value of what? According to the additional, the fair value is 939, another loss. So come and see a trade receivables. We can put in bracket 1020 minus 939. So what is the loss in terms of datas? 1020 minus 939 looks like a loss of 81. Good. After trade receivables, let's go to the balance sheet. Is there any other current asset from the balance sheet? No. So according to the balance sheet, those were the only current assets, inventory and trade receivables. So we are through with identifying the assets that are giving us a loss. Good. Now we look for the other losses now, components. I have already talked about them. One of them is reconstruction cost, which we have already been given under note number 1. Let's go and pick it. From note number 1, we were told from the additional number 1 that the cost of the scheme of reconstruction was estimated at 4.5 million. Good. I have told you our figures in the balance sheet are already in thousands. So if I put this in thousand, it will be 4,500 to represent 4.5 because our balance sheet figures were in thousands. Good. After that, I'm still looking for losses. After assets, after reconstruction cost, I also talked about accumulated losses themselves. Good. Bring them in. Accumulated losses. How much were they in the balance sheet? According to the balance sheet of this company, the accumulated losses were how much? Good. I can see it up here. The accumulated losses are 615,000. 615,000. Pick it. Good. That is 615,000. After that, I told you another component that can give rise to losses is any contingent liability. And in our company, and our example is preference dividends in arrears. So come and see your preference dividends in arrears. There is a note that told us preference dividends were 2 years in arrears. Preference dividends were 2 years in arrears. So we need to calculate. So we go back to the balance sheet and check what was the rate of dividend. If you look at the balance sheet pale juu, if you look at the balance sheet up there, our preference share capital had a rate of 9% per annum, and the capital value is 300,000, which of course I've told you our balance sheets are in thousands. That's about 300 million. So if the rate of dividend is 9% per annum, so it will be 9%, multiply that by 300 million, multiply that by 2 years. We are told preference dividends were 2 years in arrears. So every year they normally earn 9%. So what is 9% of 300 million? I multiply that by 2 years. That comes to 54. That comes to 54. Good. So I have identified all the losses. Assets, reconstruction cost, accumulated losses, and preference dividends, which is a contingent liability. I told you from this question, there were no changes in liabilities. No. So I can now get the totals before I minus the gains. Let's add these totals. The first one is 45 plus another 45 plus 60 plus 30 plus 81 plus 4,500 plus 615 plus 54. This gives me 934,500. 934,500. That's what I'm getting. Then we come and say less gains. We have already identified two of them. One of them was land. I remember the values. Land, we were told by note number 3, 777. I remember. While the book value, I remember, was 720 in the balance sheet. Was 720 in the balance sheet. So let's see, by us reconstructing, we shall make a gain of how much? 777 minus 720, I'm getting a gain of 57. Use it to reduce the losses. Good. The other gain I saw was revaluation reserve. There was that reserve to be written off, so we can call it revaluation reserve. Revaluation reserve to be written off. Revaluation reserve to be written off. So let's go to the balance sheet and find out how much was the revaluation reserve. How much was the revaluation reserve? If I look at the balance sheet up there, I'm seeing from the balance sheet, our revaluation reserve is given as for 50,000. So we minus that for 50,000. So let's get the net now. We get the net. So we take that 934,500. We minus 57. We minus 450. And that leaves me with about 427,500. 427,500. That is what we can now call total loss to be written off. Total loss to be written off. Good. Total loss to be written off. So that's all for that step number 1. Now we call a meeting of the stakeholders. We want to find out who among our stakeholders should suffer this loss. Should it be the ordinary shareholders? Should it be the creditors? Should it be the debenture holders? Why? Because we say you cannot request a stakeholder who knows that if he goes to court and asks for the company to be liquidated, he will be paid. So we can't ask him to suffer this loss. We can only ask that stakeholder who knows that even if he goes to court and asks for the company to be liquidated, this will be the procedure that will be followed. And by the end of the day, you as a stakeholder, you will get nothing. So why can't you accept that you suffer this loss now with the hope that the company will make profit in the future and you will participate in that profit, other than asking for the company to be liquidated and you lose? Good. So let's go to step 2 now. Step 2, maybe you can put it down as I dictate. Step 2, put it down this way. Step 2, put it down this way. Prepare, step 2, prepare a distribution statement. Prepare a distribution statement of the sales proceeds. Prepare a distribution statement of the sales proceeds from the sale of assets. Prepare a distribution statement of the sales proceeds from the sale of assets. Prepare a distribution statement of the sales proceeds from the sale of assets on the assumption, continue, on the assumption that the company is liquidated. Prepare, I've said, prepare a distribution statement of the sales proceeds from the sale of assets on the assumption that the company is liquidated. Then you say this. This is done, continue, this is done so as to determine, this is done so as to determine who among the stakeholders, this is done so as to determine who among the stakeholders of the company should be requested. This is done so as to determine who among the stakeholders of the company is to be requested to suffer the loss in step 1. This is done so as to determine who among the stakeholders is to be requested to suffer the loss in step 1. Then you can say this, i.e., whether it is the ordinary shareholders, whether it's the ordinary shareholders, preference shareholders, debenture holders, or creditors. Now we can do it. Now we can do it. So let's go back, listen, and see if our assets are sold, furniture will get how much, motor vehicle how much, land how much. Then we start paying the liabilities in order of priority now. So they go to the balance sheet now. We go back to the balance sheet, pick one asset, see from the additional information how much it will be able to realize. Okay? We can even use the additional, because that's where we are given the fair values. Yes. You can see from the note number 3, the fair values of the assets were as follows. One of them is land. So land can be realized 777. Furniture 420, 435. Motor vehicle 45. Inventory 210. Trade receivables 939. Good. So let's now do it. Now, I want to explain something. I think one of the assets, listen, one of the assets was used as security. And I told you, when an asset is used as a security for the secured liability, you must net it off against that specific asset. So I go back to the balance sheet and I want to know which among the assets was secured. Which liabilities was secured on a particular asset. If you look at the balance sheet, among the non-current liabilities, we have the 10% debenture, which was secured on land and building. Good. And the value I can see now here is 500. So you remember from our note number 3, our land and building was to be sold was 777. But now it was used as security for debentures, and the liability is 500. So we minus direct. So come and just put it this way. Let me first put it down. You come and see your land, 777. Then you come and see a less secured debentures. That is 500. Then when you minus, you remain with a balance of 277. That was the only liability, the only asset that was used as security. Good. Now we can list the others. There was no other asset which was used as security. It was only land. So we go back to note number 3. And we pick the other assets. In case they are sold, they will realize how much. We have already seen land will give us 777. Now we go to furniture, 435. We come now to furniture, 435. After furniture, we go to the next one, motor vehicle, 45. Next one, inventory to 10. Inventory to 10,000. Last one, trade receivables. Trade receivables, 939. Good. Now let me explain something again. Those are the assets from note number 3. Listen. Then you go back. Listen to this. You go back to the balance sheet and check. What about cash? We don't sell cash or bank. So if there is an asset of cash and bank, we just add it direct. Because you can't sell it. You just realize it. It's already liquid. Good. So let's go to the balance sheet and we check whether we have an asset called cash and bank among the current assets. So if you look at the current assets, we only had 2 assets, inventory and trade receivables. There was no bank, no cash. Otherwise, if some questions have it, add it. Good. So that's all. Now we can get the total now. Let's say the total amount of the amount to be realized in case the company is liquidated. So I'm adding 277 plus 435 plus 45 plus 210 plus 939. I am getting a total of 1906. 1906. Then I told you the liabilities have to be paid in order of priority now. Already I've paid the first one, and that is which one? The preferential creditors. I've already paid the secured liabilities. I've already paid the secured liability. So we said the other liabilities now are to be paid in order of priority. I told you after paying the secured liability, you pay any liquidation expense. Listen, for this question, the examiner gave us under note number 1 that the cost of reconstructing the company will be estimated to be 4.5. So that is the same as liquidation. Just come and say here, less liquidation expenses. Liquidation cost, it was 4.5. Our figures are in thousands, so it will be 4,500. Our figures are already in thousands. That will be 4,500. Note number 1 told us that the scheme of reconstruction, the company, the cost of reconstructing the company will be 4.5 million. That's the same as liquidation cost. So if I minus from 1906, if I minus 4.5 million, that leaves me with a balance of 1901, 500. 1901, 500. Then we go to the next liability in order of priority. Now you know I have told you, after paying liquidation expenses, I told you now pay the preferential creditors. You come and say less preferential creditors. There is a note that talked about that. There is a note that told us out of the creditors, this amount was considered preferential in a liquidation. Which one amounted to how much? Note number somewhere talked about liquidation expense, preferential creditors. That was note number 5. It says trade payables include shillings 125 million that will be preferential in a winding or in a liquidation. So 125 million, our figures are in thousands, that will be 125,000. So let's minus 125,000. So assuming we paid the preferential creditors their money, what shall we be left with? So I minus 125, and we shall be left with a balance of 1776,500. 1776,500. After paying the preferential creditors, I hope you remember the next one. I told you the next liability to be paid will be the debentures. Listen, debentures on a floating charge. Or in other words, I told you any liability which is on a floating charge. This question did not have debentures on a floating charge, but I do remember, when we were reading the balance sheet, our bank overdraft was secured on a floating charge. I think so. Let's confirm from the balance sheet. I think it was the one which was secured. There was a liability which was on a floating charge. Yes, I can remember now. Here it is. We are given among the current liabilities, bank overdraft secured on a floating charge. And the bank overdraft amounts to 500,000. So let's pay that overdraft now. It is secured on a floating charge. So come and see here less. Bank OD secured on a floating charge. Bank OD secured on a floating charge is 500,000. Once I pay that amount, we shall be left with how much? We shall be left with a balance of 0056721. 1,276,500. Okay. I do hope you remember the next liability in order of priority. I told you after paying the debentures on a floating charge, you now pay the unsecured creditors. And I told you unsecured creditors are those liabilities that don't have any security. It can be any other liability, whether bank overdraft, whether bank loan, whether the normal creditors, any liability that your company has. If it doesn't have any security, then it's classified as unsecured. Good. So we come and less unsecured creditors. From this balance sheet, let me confirm which liabilities we have and whether we have secured or not. If you look at this balance sheet, we have a 10% debenture that was long-term. It is already secured. Among the current liabilities, we have bank overdraft. It is secured on a floating charge. So the only liability that we are not told anything is creditors, which is the trade payables. According to this balance sheet, it's given as 1025. Listen, but you also remember there is a note that told us, there is that note, I think number 5, which said what concerning them. Note number 5 told us trade payables include 125,000 or 125 million that would be preferential. So if the creditors according to the balance sheet were 1025, from this balance sheet I can see creditors are 1025, out of which 125 are already preferential, which we have already used. So how many out of 1025 are unsecured. So we come and take that working and we say 1025 is the total, out of which 125 is preferential, which we have already used. So it leaves me with a balance of how much? This is 1025 minus 125. That leaves me with a balance of 900. So if we pay the unsecured, looks like money is still remaining. How much? If we pay the unsecured, we are remaining with a balance of how much? We take 1276.5. That looks like 376,500. 376,500. Good. So we have paid the secured credit and the unsecured. They have enough money to go home with in case the company is liquidated. After paying the unsecured creditors, we now come and say less preference dividends in arrears. I told you, once you pay the unsecured creditors, the money that remains now, you are supposed to give it to the shareholders. There's two categories of shareholders. We have preference and we have ordinary. For preference, they rank first. But what do you pay them first? Do you pay them their arrears first, or do you pay them their capital first? We saw you pay them their arrears first. So let's go back. We have already calculated the arrears. We don't have to recalculate them again. Under step 1, when we were computing the contingent liability, we saw that preference dividends were 2 years in arrears and it came to 54,000. So let's use that 54,000. So we pay that 54 for the arrears. We shall be left with how much? I am left with a balance of 322,500. 322,500. Now we can give the money. We can pay the preference share capital now. Let's pay preference share capital. So let's go to the balance sheet and see how much do we owe them and whether we have enough to pay them. We are remaining with a balance of 322. The next category of people to be paid are the preference shareholders. Do we have enough to pay them? That's what we want to know. So from this balance sheet, how much is the preference share capital? You can see we have 9% cumulative preference shares, 9% cumulative preference share capital, worth 300,000. So we have enough. We have a balance of 322. Now we want to pay 300 to the preference shareholders. That leaves me with a balance of 22,500. 22,500. And I've already told you, any money remaining must be paid to the ordinary shareholders. So we come and say a less ordinary share capital. All that remains is theirs. That is 22,500. So that we are left with nothing. But the question is, have they been paid enough? That's the question we want to confirm. Everybody else seems to will get. The last person we are paying is the ordinary. We can only pay them 22. But from the balance sheet, what is it that we owed to them? What is it that we owed to them? If you look at the balance sheet, our ordinary share capital was for 50. I can see the share capital is for 50, but we can only pay them for 22,500. So if they go to court, they can only get 22,500. Who? The ordinary. But we owe them for 50. So if they go to court, they will still lose how much? Let me check. I take that for 50, which is what I owe to them. If they go to court, they will be paid 22,500. So they will lose a balance of 427. They will lose a balance of 427,500. Is it exactly what we got in step 1? Let me confirm. Is it exactly what we got in step 1? Yes. 427,500. So we want to tell the ordinary shareholders, please accept to suffer this loss of 427,500 with the hope that we shall make some profit in the future and you will be able to participate in that profit. Otherwise, if you go to court, you ordinary, you will get how much? 22,500. and you will lose how much? You will lose 427,500. But if you accept, we reconstruct, suffer that, but with the hope that we shall make our profit in the future. Now, before we go to step 3, I want you to look at this. Let me put down here a summary. Don't put it down first. Let me put it in form of a table. Then I will let you copy. I think now you can copy. We have a column for amount due, amount paid, and amount lost. We could start with preference shareholders. Maybe we could start with them first. Preference share capital or preference shareholders. We owed them how much? We paid them everything. We owed them 300. If they go to court, they'll be paid the same 300,000. They will lose nothing. What about the ordinary shareholders? We owed them that for 50. That's what we have seen. According to the balance sheet, if they go to court, they can only get 22,500. Therefore, they would lose the 427,500, which comes to the same total that we got in step 1, 427,500. Okay, so let's put down a note somewhere below that. Put down this. Below that, put down this. Below that, put down this. From the above table, it is the ordinary shareholders. It is from the above table, it is the ordinary shareholders who should be requested. It is the ordinary shareholders who should be requested to suffer the loss in step 1. We have said from the above table, it is the ordinary shareholders who should be requested to suffer the loss in step 1. Good. Now we can go to step 3 now. Now we can go to step 3, where we said you determine the loss, reduction per share. Determine the loss reduction per share. How? We said you take the total loss, we divide that by number of ordinary. Now we know the type of shares to lose. We are dividing that by number of ordinary shares. We are dividing that by number of ordinary shares. We have a loss of 427,500. That's the amount we are writing off. We go back to the balance sheet and check how many shares the company had in form of ordinary. How many shares did this company have in form of ordinary? That's what we want to know. According to this balance sheet, I can see ordinary share capital, 10 shillings per value. The amount is given as for 50,000. I've already told you our figures are in thousands, so that is 450 million. One share has a par value of 10. So if the company has a capital of 450 million and the par value per share is 10, that means the company has 45 million shares to give us 450 million. So that is 45 million. Our figures are in thousands, so we just say 45,000. So how much is the loss reduction per share? Loss reduction per share. So we take that 427,500, we divide that by 45. That looks like a net of 9.5. That is 9.5. That's our step number 3. We want to go to step 4 now, where we said suggest a scheme. Step 4, we said you suggest a scheme of internal reconstruction. Suggest a scheme of internal reconstruction. Suggest a scheme of internal reconstruction. So let's suggest now. We have everything we need. We have everything we need now to suggest a scheme. Number one, let's put it down. You come and say ordinary shares to be reduced by 9.5 per share. Ordinary shares to be reduced by 9.5 per share. I told you, anything you got in step 3, anything you got in step 3 must be part of the scheme. Anything you got in step 3 must be part of the scheme. Good. That's number 1. Then I told you, number 2, number 3, number 4, number 5 item in the scheme, you go back where I told you, you go back to step number 1. I told you, anything we used in the determination of the loss must be part of the scheme. What are these? 2, you remember we had to revalue some assets. Under note number 3, we were given the fair value of the assets. So you can put down this statement number 2. Number 2, say this. Number 2, assets to be revalued. Assets to be revalued to their fair values. Assets to be revalued to their fair values as follows. Assets to be revalued to their fair values as follows. I remember the first one was land and buildings. That was 777,000. I remember. I am going to copy note number 3 as it is. So let me go and copy note number 3 because that's where the fair value of the assets are given. So I'm copying note 3. After land and building 777, I come to furniture. That is 435. Furniture. 435. Next one, I'm just going to copy everything in note 3. Next one is motor vehicle. And the motor vehicle is 45. Next one is inventory. Inventories. And the amount is 210. Next one is trade receivables. And the amount is 939. Good. So I've copied note number 3. So I'm through with a second item in the scheme. We want to go back to step 1, which I hope by now you know the items we used. We don't have to keep going. We know them now. So when the assets will be revalued to this much, one of them called land will give us a gain, the rest will give us a loss. Next, number 3. Listen to this now. Number 3, you remember, one of the assets called goodwill is not in this list because it had no fair value, but we were told it is considered to be valueless. So andika somewhere, which we shall include now in the scheme. Goodwill is considered to be valueless, and therefore it should be written off. Goodwill is considered to be valueless, and therefore it should be written off. So you remember in step 1, we used part of goodwill. I remember it was 60. Next, after that, what else did we use in the scheme? Let me just take you back so that we go together. So far, among the losses, we have used the assets. I hope you can see there. And the inventory and the goodwill. Now I can see there is this reconstruction cost of 4.5 million. So let's add it in the scheme. So number 4, you can add reconstruction cost. Reconstruction cost of shillings 4,500. Remember, our figures are in thousands. So I'm putting in the figure again in thousands. Reconstruction cost of shillings 4,500 to be incurred. To be incurred. To be incurred. Okay, we go back to step number 1. We are still looking for what else formed part of the loss. After that reconstruction cost, what was the next one among the losses? I can see now we have dealt with the reconstruction. We now go to the accumulated losses. So andika number 4, number 5, I think so. Number 5. Accumulated losses to be written off. Accumulated losses to be written off. Accumulated losses to be written off. Good. Let's go back to the scheme. What else form part of the loss or even gains? That's what we are trying to look for. After that, I'm going back to step 1. After that, I can see we have talked about accumulated losses. Now I can see preference dividends. So we can say something like this. Come and say number 6. Preference dividends in arrears to be paid in cash. To be paid in cash. Or somebody else could have suggested. That preference dividends in arrears to be converted into ordinary. You remember we talked about something of that last time, where you can also convert the preference dividends in arrears into ordinary. That one we discussed it in our last lesson. Good. That's all. I think next, let's see what else we used as part of step 1. So far, I've used the preference dividends. Among the gains, I've already talked about land, which is part of the assets that was revalued. Next, we can now have revaluation reserve to be written off. Now quote it. Revaluation reserve to be written off. That's number 7. Revaluation reserve to be written off. To be written off. So we have done part A of that question now. We have done part A of that question. We have done part A of that question now. We are supposed to do part B now. Okay. Somebody's asking, is it reduced by or reduced to? Okay, listen, I think it's Joy. Listen to this now. When we did step 3, we got the loss reduction per share to be 9.5, sorry. We saw, listen, we saw one share has a par value of 10. So I told you, I think even last time when I was discussing this, we said, one question could say, ordinary shares to be reduced by 9.5, which we have done. Another question could say, ordinary shares to be reduced to how much? 2. Ordinary shares to be reduced to. Remember, one share originally had a par value of 10. Note step 3 says we reduce one share by 9.5. So another way of framing the same thing is just to say ordinary shares to be reduced to, now you say to 0.5. Because you are reducing them by 9.5, yet the power value was 10. So if I am reducing them by 9.5, then I'm reducing them to 0.5. I hope you're okay, Joy, now. I hope you're okay with the answer. Yes, you could still have said, step 1 in the scheme, you could still have said ordinary shares to be reduced to 0.5. That does not change the answer. We shall still use the same loss. Whether you say to be reduced to 0.5 or you say to be reduced by 9.5, it's still the same. That does not change the answer. It's only the language. Joy, are you okay now? Yes, thank you. Now, for now, listen, I want to talk to the new students. I want to talk to the new students because today was a free class and I can't start number B and complete it. We want to implement the scheme. But before we do that, I want to talk to the new students who are in the group learning for today because today was a free class. Now listen, for the new students, if you wish to continue with us, for advanced financial reporting, then you need to know this. We have either early morning classes or evening classes. Talking to the new students now. Our early morning classes normally starts from 5:30 in the morning to 7 a.m. in the morning every Monday, Wednesday, and Friday. If you choose evening classes, our classes are from 8 p.m. to 10 p.m. again every Monday, Wednesday, and Saturday. Now listen. Our system is such a way that in case you miss a class, let's assume you are in the evening and on Saturday you have a function and you want to attend, does it mean you will miss that class of Saturday? The answer is no. You can go back to the group where the link was posted and you click on the link and you'll be able to watch your video at your own free time. Same to early morning group. If you miss a class, don't panic. Just go back to the group, click on the link, and you'll be able to watch your video at your own free time. Okay. We have already covered a few topics. I can give you the videos of those classes. That's not a problem. I'm talking to the new students now. Now, instead of, maybe for some of you, you may not be available in the morning, you're not available in the evening, you can also buy what we call pre-recorded videos. Meaning you get the videos for the whole syllabus at once and you listen to them at your own free time, at your own pace. That's what you can also do. You buy what we call pre-recorded videos. We are charging 4,000 shillings, either for the normal class or for the pre-recorded videos. Okay? If you are interested in either class or pre-recorded, you can call me on this number. You can call me on this number 0722 6588 0722 658875 0722 658875. Again, I would ask you, this is for everybody now, please subscribe to my YouTube channel so that you get notifications in the future whenever I post the videos. Listen, the name of my YouTube channel is called CPA Joseph Njuguna. CPA Joseph Njuguna. That's the name of the channel. So that's all you need to know concerning for advanced financial reporting. Listen. Some of you have friends who are doing financial reporting of the intermediate level. We are also teaching that. If you have friends who are doing a financial reporting of the intermediate level, the classes are from 8 p.m. again to 10 p.m. every Tuesday, Thursday, and Friday for financial reporting. Again, they could also buy the pre-recorded video. They could also buy the pre-recorded videos. That's what we're saying. The charges are still 4,000. We are also offering financial accounting of the foundation level for the beginners. We also have financial accounting for the beginners of foundation level, or the financial accounting of ATD1 and ATD2. We are still charging 4,000 shillings. Again, they can buy the pre-recorded videos. I think I've explained everything that you needed to know, especially for the new students who would wish to join our classes, So let's now, maybe we can stop there. Somebody has asked a question. It is a must we follow a certain order in recording the items included in the scheme? No. Somebody's asking, James is asking, must we follow a particular order? No. But I've told you it's logical that you start with what you got in step 3, because that's what you have just got, so that you don't forget it. Others, what appears in step 1, you could start with any other item. After number one saying ordinary shares to be reduced by 9.5, you could say number 2, accumulated losses to be written off. 3, contingent liabilities to be paid in cash. That is preference. Number 4, revaluation reserve to be written off. Whatever it is. So the others don't have to go in a particular order. Why? Because even when you are implementing them, that number 5 does not affect number 6. Number 6 does not affect number 7. No. They are all independent of each other and they don't affect any other entry. Thanks. Okay. So James has said, okay, good. So maybe for now we can stop there. I've talked about for the new students who would wish to join. Either we have early morning or evening class. Either from 5:30 in the morning to 7, Monday, Wednesday, and Friday. Or evening from 8 p.m. to 10 p.m., Monday, Wednesday, and Saturday. I've talked about in case you miss a class, you can still be able to get. Of course, I'll also give you the videos of the previous classes that we have already covered. I've talked about. If you are also interested, you can also buy the pre-recorded videos. We are charging 4,000 shillings. You can buy or you can pay in installment, no problem. I've also said you can reach me on that number, 0722 658875. I've also requested you to subscribe to my YouTube channel so that you get notification. This is for everybody now, so that you can get notification for every posting we make in the YouTube channel. I've also told you, if you have friends who are doing financial reporting of the intermediate level, that's what used to be called section 3, that means they can also join. I've also said we also have financial accounting for the foundation level and the ATD level 1. So maybe for now we can stop there. We pick it up from there next time. I don't know whether we have any new student who want to comment on something. Any new student who want to say something before we close the class for now. So next time, which is on Saturday, we go to part B of the question. We now go to part B of the question. Okay? Any comment for now? Ama we close the class? Okay. Okay, fine. So see you. Good night, everyone now. Good night. Good night. Good night. See you next time. Good night. Thank you. Wonderful. Thank you. Thank you. Good night too.